Hello, I'm Christian Pomerleau. I'm a mortgage broker, commercial for PMML, and today we'll talk about the policy rate. We are today the 26th of October 2022, and the Bank of Canada continues its increases. It has announced just this morning at 10 o'clock that the bank policy rate will be increased by 50 points or 0.5%. This rate is now 3.75%. It's the sixth consecutive increase since March 2nd of 2022. We went from 0.25 to 3.25. I'd like to talk about the Bank of Canada and their decisions because in microeconomy, this is a science which works with very, very fragile and thin lines. During the pandemic, it has forced the governments to start putting money and injecting money in the system. And this was really needed because we needed to have this system to survive and not crash, basically. However, when we look a little bit with hindsight, we see that these programs have been very, very generous and also probably maintained for a little too long. In this context, normally in the pandemic, families and revenues should have gone down like drastically, but with the programs, they have increased. Now the problem is that this forced some pressure on the demand of goods and services, and on the other side, it was difficult for the companies to follow this rhythm. And this is why prices of products have started to go very high. And also the lack of employment of employees created pressures on salaries, and this amplified and increased even more pressure on the prices. It's like a wheel that auto feeds itself. Now the banks, the central banks, have to do drastic decisions to break this momentum without crashing the economy. So you have to know that the Bank of Canada works like almost blind because whatever decisions they make today will only have impact and we'll see in 3 or 4 trimesters, you know. So what really worries the economists is the evolution of the inflation and also how the economy will land in 2023. Now, the National Bank economists say that it will not be obligatory to maintain the levels, the rates very, very high for long. So they think that the Fed and the Canada also will start reducing the rates probably by the second or maybe third semester. In the world, the major thing is really inflation. So many central banks have increased their rates. About every bank has done that except the Bank of Japan. It's really the American Fed which dictates the tone of all this. And they are pretty aggressive in their policy right now because, first of all, it didn't have much impact yet on inflation. And there's a lot of little statistics that they look at and they want to be a little more aggressive. Now this has an impact on the whole world and we have to make sure that we're not just going to shut the whole thing down. So it's very important for the Fed and for Canada also to make sure that their decisions are going to be good. The only challenge is that the real record we'll only know in about 1 year. Now, China is still under surveillance, again, because of their zero COVID policy and all those companies that they keep closed. And this creates a big problem with having the products and goods being transported here. And also the real estate, the Chinese real estate is in distress and it has also incurred a big reduction in demand for basic products. So that's an important thing. Now, we know that Europe is in a crisis, also in the energy crisis, and it might bring a lot of countries in recession. In the United States, the work market is pretty rough, is pretty good, even though offers have reduced lately, and inflation is still pretty high. So they expect a third trimester with a growth. However, we still have a lot to do on this economy, And right now what we're looking at a lot is the real estate market, which has really declined by 28% in terms of resales compared to their highest level this year. And also the demands for mortgage went just way down. In Canada, our interior demand is still very strong, and we have a very good work market. Unemployment level is at 5.2, but still we have we kind of see weaknesses in the economy. And all these increases have reduced the economy, and still inflation persists. So the consumers, investors, and companies suffer from that a lot. An important increase in unemployment level and other increases in interest rates will just amplify the correction that is going to happen in the market. Lately, you have seen that the returns of government bonds have increased about everywhere in the world. It's a situation which reflects a lot of the unconfidence of investors with the financial stability. And even though the trust is building right now, the tightening of banks in their policy to control inflation, and also the economic maybe tensions and recession that's upcoming reduces a lot of the confidence in the market. The inflation as measured by the government is 6.9%. And the big forces that are at play right now is the increase in the cost of food and the also housing, but it's counteracted by the price of gas. There's still 65% of the elements that are calculated to calculate inflation, which show that there's a 5% or more increase. If we look into Quebec, the growth interior product has been limited to about 1% annualized. It is a big decrease since the second semester, and our economy is a little fragile right now. The question is not if we're going to have a recession, but how big that recession is going to be. Now, the work market shouldn't deteriorate too much because we still have a lot of lack in workmanship, so we need people, so this should be okay. But the expenses of consumers are going down. They were good till the mid of the year, but they're going down. And again, I talked about the trust of consumers in the market, and that too is going pretty much down. The good side is that in Quebec, we still have about 10% of economies aside. So with a good work market and salaries going up, we should be able to sustain the shock. Now, real estate. The real estate, we have seen an increase of 10.8% of construction sites being put out there. Most of them are multi-residential, but Montreal is still lacking. We're still negative since the last 3 trimesters. So this is something the sellers have sold, also lost their position, their forced position as sellers. So this is changing a lot. The high inflation and the high cost of borrowing is reducing the demand. And the average price of homes went down by 4.1%. And by the end of 2023, Desjardins said that the prices should go down by 15 to 20%. So we know there's a correction out there for the real estate market. Desjardins has described this as having 3 phases. The first one is the reduction in sales and the reduction in prices of properties. The second level is when you have a slowdown in construction and major renovations. And then the third phase is when all the other sectors start being affected, like financial services and everything else. So, dear investors, it's a good time right now to review your objectives, to look at the market out there, to be prepared for opportunities, because there will be opportunities for sure. and just be on the lookout. I hope this capsule will help you. Don't hesitate to contact me to talk about financing, commercial, and multi-residential financing, and also the MLI Select program. And I could be reached at by email at christian.pomerleau@pmml.ca. I repeat that, christian.pomerleau@pmml.ca. For those who are interested in knowing where I take my sources, they come from les études économiques de Desjardins in the section Prévision des taux de détail et nouvelles économiques, and also all the communiqués, the media from the Bank of Canada, and le mensuel économique de la Banque nationale du Canada dans la section marché financier. Have a great week and good real estate.